The economy is far from being back on track, yet junk bond investors are growing much more confident that highly leveraged companies will be able to pay their debts. Spreads over treasuries have narrowed dramatically since the end of last year and now are close to an 18-month low. Can the rally continue, though? And what does it say about the health of credit markets? It's a question we're putting to Martin Fridson, a pioneer in high-yield trading and strategy, who's now founder and CEO of Fridson Investment Advisors. Marty has been dubbed the dean of the high-yield bond market. Quite a calling card, Marty. We've been talking this morning about concerns you have about the lowest-rated junk bonds, the ones that aren't currently in default, the CCCs. How about the rest of the junk bond universe? We've seen this big rally, spreads coming in. Can that rally continue?
Yeah, I think it can. I think it will over an extended period. There's always a possibility of a pullback just because you have some technical traders who are involved in the mutual funds, which have a lot of impact on the short run on the performance. And there's always a possibility of some negative numbers or unfavorable numbers coming along in the employment statistics or other economic indicators. The longer-term trend, let's say the next 6 to 12 months, I think will continue to be positive.
Why is that, though? I mean, give people, you have to be... Some of these companies are pretty highly leveraged. Now, that's a very broad brush remark, but the economy definitely hasn't turned around. You could look in any number of industries and see trouble. Okay, profits are coming in ahead of expectations, but they're still way down. There just isn't that much cash flow out there.
Yeah. Well, remember, for these companies, they don't have to have earnings gains, which is really what the stock market is looking for, as long as they can keep their head above water, continue to pay interest, and refinance their debt. And that's one of the big changes. The capital markets have reopened to a considerable extent, so there's greater confidence that the companies that have large debt maturities coming due over the next couple of years will, one way or another, find their way to roll over those debts.
Martin, you somewhat referenced this point about unemployment continuing to grow. I mean, does the economic recovery justify what you're seeing?
Well, that's still to come. Of course, the latest quarter was a comparatively mild drop, so I think people are starting to see an improvement. And I think equally important, what has been very little commented upon is the default rate has actually already started to come down. The number you see reported is the trailing 12-month figure. That rose in the last quarter only because the comparable quarter from the earlier period, when default rates were still much lower, dropped out. But quarter to quarter, the default rate has already started to come down.
So that's, I think, from Moody's, right? They say it's around 10%. I remember at the end of last year, they were forecasting default rates close to 20% by the end of this year. You don't think we're going to get there?
No, they're down to about 12.8% as a peak in the fourth quarter. Standard & Poor's is a little more pessimistic, still seeing a 14% rate out in early 2010. But those numbers have come down quite a bit from the low point where you had 7 out of 8 companies trading at distressed levels, indicating if that was really a reflection of their credit risk, almost a 1 in 4 chance of going into default within a year.
Okay, so for spreads to narrow, people have to be reevaluating their expectations for bond repayment, but there also has to be demand. Without CDOs, without CLOs, which accounted for so much of the buying of high-risk credit, where's the demand coming from?
Well, the demand is still pretty muted on the loan side. The bond market has come back and recaptured some of that new issue market share that it gave away at the time that CLOs were booming. So that's still a ways to go before we see a lot of new CLO creation. But on the bond side, some money has come in. Of course, the mutual funds have had steady inflows, just a couple of weeks here and there. Again, I think more on technical reasons or in response to short-term economic indicators.
All right, Marty, I'm afraid we have to end it there. Marty Fridson, Dean of the High Yield Bond Universe, joining us here on set.